All right, we're just about to start out, and Klaus, no, Liam is will not be joining today. He's actually working right now. He's crunching some data, but I will send your greetings to him. Absolutely. All right, it's 7 o'clock here, at least in Denmark. I know we have participants that are popping in from, well, a bit not all over the world, but at least in several time zones. Many of which will either be joining us shortly or will see the recording when we are done here. So let's just get started. Welcome to all of you, and thank you for spending 45 to 60 minutes here with me tonight. My name is Hans. I am the daily owner of, I am the owner of the company Market Timer, and also a partner in the software MyStockScanner. I suspect you can see my screen here. Otherwise, please let me know. MyStockScanner is a new project we have been developing on. Thank you, Klaus. MyStockScanner is a project we have developed over the last year and a half or so. And I'll not go into details with everything about MyStockScanner tonight. There are a lot of features by now, and we are putting more in almost weekly. But as you can see, we have some watch list where you can build portfolios, you can build your screeners. I will look at the screeners tonight, or at least one of them. We can see the latest videos I have made on the Building Freedom channel, and there are the economic news. Out to the left here, if you don't know the software, you can go through all the different items here in the menu. And today, as I said, we will be focusing mostly on a single screener called the TPI Swing. But first of all, I will just pop into a slideshow that I did just lately on the Building Freedom channel. It was called Be the Casino, and I'll just take a couple of nuggets from there tonight, because that is quite important about the topic tonight, because we're going to have a look at the TPI indicator. That is an indicator we have built inside the MyStockScanner, and we had a very good feeling it would work. It's an idea that I have been brewing on for years, but I haven't had the technical skills to build the indicator myself. Stats. We're looking at stats for each individual stock, and we are trying to determine the waves it moves in over a lot of different time frames to get a good statistics of when will it bottom out, when will it top out, and so on. I'll show you some of that tonight. But first of all, the reason why it is important, and that is one of my main things when I do my investing, that is you need to be the casino. Now, what do I mean about that? Well, if you've ever been in a casino, you know that the owner of a casino, they are always, on the long run, the winner. Meaning that the more people gamble, the more they win, because they have what is called a positive expected value of every single bet that is placed on, for instance, a roulette table here. And let's just see, more people are coming in. Welcome, welcome. And well, let's go into the casino, but not with the roulette table. And let me just quickly explain to you what I mean by a positive expected value. Now, I'll not go through the entire slideshow here, but a positive expected value when you're trading, when you're investing, is where you have stats for your trading, and that is where technical analysis come in. I'm often told that technical analysis, looking at charts, is some sort of magical thinking and that it can't be used. But I'll show you tonight that it can. And what a good thing about technical analysis is that you can put up some rules, some very, very strict rules. You can put them into a computer. I cannot do it, but my partner Liam, business partner, he can. We put them into a computer and we can test them as far back as we have data. And we know exactly when we would have entered, when we would have exited a trade, and we can calculate how many winners we would have, losers, how large our average winners are, and so on, so we can see if we have an edge. That is what tonight is about, how to build an edge. All right. The positive expected value, and I'll do this short, I promise you. Don't get scared away by the math here. Let's just say that you're placing 100 trades in the market, and you have 60 winners and 40 losers. Maybe these are real trades, or it is a back test where you're putting the rules up in a software program and back testing through historical data. So you have 100 trades. Let's say you win 60. Loser. All right. And I'm not sure. Did I disappear? I got a little error message on the screen. Hear me and see my screen. All right. Thank you, Klaus. Sorry about that. I'm not sure what happened to the connection there. However, back to positive expected trades. 60 winners, 40 losers. The average winner is on $100. The average loser is $100. Now we can put this into a little calculation saying that if we have the 60 win, $50, and that's not $1,000. All the lose dollars, that's $4,000. So altogether, we win $5,000. This PEV, that is called a positive expected value per trade, is now the 5,000 divided by the 100 trades, meaning $50 per trade. Now, what does that mean? $50 per trade is our positive expected value. That doesn't mean that we'll win $50 every time. But just as a guy that owns a casino, he knows that when 10,000 people have placed 500 bets each, he will end up being the winner because of stats, because the stats are on his side. And that is where we want to go with our trading. And that is why I know some people are making money on it, but it is why I normally recommend that, especially new investors, don't try to figure out the market. They shouldn't try to guess who will be the winner of the EV sector 20 years down the road, or what will the oil price or the interest rate mean to that single stock, or what I'm trying to pass on knowledge to these new traders is you need to build a structure, a system, a mechanics that you can repeat over and over again. Because if you knew that you would make $50 on average every single time you took a trade, I think you as many trades as humanly possible. Every single hour you would be trading as many trades as you could, because you knew that after 1,000 trades you would be up $50,000. So that is what we are going to have a look at tonight here. And for that, we will into MyStockScanner. All right. If you haven't signed up to MyStockScanner yet, you can do it. I'll put a link under the video when I upload to YouTube and share it in my Facebook groups. But we are here in MyStockScanner. And first of all, I'd like to introduce the TPI indicator. Now, some of you are familiar with it already, I guess. Let me just see if I can get this away. All right, we'll just use this one. I'll search for the Danish stock Novo Nordisk. They have become famous lately for their weight loss drugs that I've heard is quite effective, and they are selling a bunch of it. Now, when you look for Novo Nordisk here, you can look at a ton of different numbers, but we're not going to do that tonight. We basically don't care if they're selling drugs or wood or cars or whatever, because what we're doing is we're looking at the TPI chart. TPI stands for Turning Point Indicator, and that is what we have tried to build in here, an indicator that shows us if it is statistically probable that a stock price is going to turn either up or down. Now, as you can see below the stock price here, and I should say we are working on a lot better charting package here. So we are getting a bit more like a trading view. Welcome to those of you that are popping in. I know that some of you are, it's a bit of a bad timing for you, but welcome to all of you. But when we are in here, we're just looking at the TPI indicator, and there are three different rows here. There's the lower row, that is the long-term trend. And that is something that can be used to track, is this a stock I should try and swing trade in, for instance. If we are looking back in time, we can see now Novo Nordisk is a bit of a bad example, you could say, because they're just moving up all the time. There are short periods where we are having the red here. Let me see, Klaus, the daily and weekly team are clearly based on daily and weekly price action. But what information is the TPI trend value based on? Is a market index? All right. Well, I can't, of course, spill all the details, but the basics of the TPI, no matter if you're looking at the daily, weekly, or a long-term time frame, that is, as I said, we are taking the stock price of, for instance, Novo Nordisk here, and we are slicing it up into a lot of different time frames. And on the daily, we are down to some very short time frames, also intraday time frames. When we are at the weekly, we look at a bit longer term time frames, and the long-term trend here is just some very long looking back time frames we are looking at here. So it's basically all the same, just on different time frames we are looking at. And then we are crunching a lot of stat every time we ask the software to pull a chart like this up. It is crunching all the numbers for especially the long-term trend very far back in time, and it is looking at the distances from tops to tops, from bottoms to bottoms, and it's making a statistical assumption of when will the next top and the next bottom happen. And that is what we can see here. Right now, the long-term trend only has red and green. I hope that was answering enough for you, Klaus, but otherwise we can get into it later. But the long-term trend here only have red and green for now. There might come an extra color because we have found some interesting stats when we have been diving into all the data. So there might actually be a third state that can be in, but we'll get back to that if that is changed. The two others here are the weekly, that is the mid one. That is actually the one I'm trading the most. And then we have the other one, that is the daily. Now, these two have four different colors. They have a dark green, a light green, a dark red, and a light red. Now, the dark green and the dark red, you should, these are the, you could say, the certain movements. This is where we are saying that the stock is actually already in a movement where the stats are indicating this one is going up right now. Sometimes it's actually not. Sometimes you will see, for instance, here we have the dark green, even though the price is actually moving down. But this indicates that we, from a statistical point of view, have moved into an area where the stock should be moving up. Now, looking at the light green, if we are looking at here, we can see the price is moving up, up, up. At some point, we move into an area where the dark green is getting less certain. And that is where this shifts to light green, meaning that now we have entered a state where it is very likely that we will soon see a turnaround. You could compare this a little bit with some indicators saying that this is the movement up. This is an overbought. We are calling it an overbought accumulation phase because that is what is happening. Then we move into a downtrend, or at least a time in the graph where the stock should be moving down. And then when that gets less strong, we move into the light red, meaning this is what could be considered an oversold area. We're calling it an oversold accumulation phase. So this is where we would be starting to look for a turning point. All right, so we have the up, the down, The green here is where the dark green is getting weaker and getting ready to move down, and the dark red is moving down, and then light red is getting weaker here and getting ready to move up. I hope that makes sense. That basically just 4 states here. And that can be happening on a weekly time frame or daily time frame. I know some of the users already are trading this on a daily time frame, and we also have some strategies. I can show you some stats about this tonight here. Some strategies that use the daily time frame as well, or the daily TPI. All right. So what is interesting here with an indicator and with technical analysis is if you can test this back in time to get an idea of if a certain strategy would have worked over and over and over again. And that is what we have done. We have pulled data back from 1986. So that is roughly 40 years, something like 38 years or something like that. And we have tested it on all the large US stocks, meaning all the stocks in the S&P 500 and the NASDAQ. Be aware that if at some point you're going to test something like this, you need to be aware of something called survivorship bias, meaning that if you're only testing on the stocks that are available today, and you're saying, oh, this is a great strategy, it really seems to work, then you're only testing on all the survivors, meaning that if you have started with all the stocks that were in the S&P 500 40 years ago, many of them will have either gone bankrupt or at least lost a lot of size. So it is important, and that is what we have done. We have tested on the actual constituents of each index each year, so that we are certain that even though a company went bankrupt or something severe happened to the company, we are still testing on it and not just on the strong companies that survived. All right. A good example of this is if you would test something on a tech stock and you would test it back in time on Amazon and Google, for instance. You might come up with a great strategy because they have been trending for many years. But what you should have done is that back in 1998 or something like that, when you started testing, you should have looked at every single internet stock that was available at the time. And 99.9% of them went bankrupt and is nowhere available to buy today. But you should have looked at the entire universe of stock at that time, even though some of them fell off. All right, that was just a bit of the technical part about the testing part. Liam, my business partner, he has been doing this for years and years and building software for it for many of the big guys in London. So he knows what he's doing on this front. Now, what we have done is that, and we have tested a lot of different things, but I'm going to show you a couple of strategies today just to give you an idea of how large of an edge you can actually get just by using this TPI indicator. You don't need to or you can, of course, add your own trend channels or moving averages or other indicators wherever you want. However, just using the TPI indicator for your timing can actually be enough. So let's go into the slideshow again here. And I have two different strategies. Now, the first one is a combination of two of the indicators. And that is the long-term trend, the one in green here, and then the daily trend up here. Let's see, survivorship bias. How do backtesting results differ on surviving stocks versus non-surviving stock? Well, they don't necessarily differ, Klaus. And in our case, there's not much difference. You just need to make sure you're doing it, because otherwise you risk that half of the stock has disappeared, and adding them into the equation would show that your strategy was terrible, for instance. So you just need to do it. And it was the reason why I mention it is that there are probably some people out there, maybe you, maybe some listening to the webinar on a later date, thinking, I wonder if he have thought of that survivorship bias, and we have. It is a part of the backtesting. But the strategy I'm going to use here, it's not it's not a real strategy in that case, but it's a way of using the TPI indicator. What we're looking for is first of all, we're looking at the long-term trend, and that needs to be up, meaning it has to be green. That is one part. And when we're looking at here, then we are looking at the TPI daily, and we have 6 different buckets of data here, meaning that if the long-term trend is up, you can either buy the daily trend when it is in a downtrend, going down going up in overbought. You can look at it going generally down in a downtrend. You can look at it in a downtrend oversold, uptrend oversold, and uptrend on uptrend overbought. These are the 6 buckets here. And if you look back here, let's just imagine that we are buying a stock. If we go back to the TPI chart here, where the long-term trend is green, and the indicator is light red, which means it is down in oversold, compared to if it is up in the light green, meaning it is up in the overbought. Let's have a look at the stats here, and I'll explain them to you. Because what this shows is that we buy a stock, for instance, when the uptrend is green, the long-term trend, and the daily has tipped down into an oversold accumulation phase. That is here, downtrend oversold or uptrend oversold. That is the gray and the yellow. Then we keep it for 5 days. No stop loss, no nothing, no moving averages, no other indicators but the TPI, buying when the long-term trend is up, when it shows that it is in a light red, so we are in an oversold accumulation phase. That's it. The stock could be going down, it could be going up. That are the 2 options here. We hold it for 5 days, then we sell. When we do that, and we have tested this over millions of trades the last 40 years, we can see that buying when the TPI is in an oversold accumulation phase beats all the other phases. If we buy it and hold it for 10 days, then buying in the oversold, meaning that the stock has probably retraced a bit, that beats all the other phases. Holding it for 15 days, 20 days, 25, 30, 35, 65, meaning a quarter, or holding it for 130 days, half a year. These are trading days, of course. Every single time, no matter what time frame we are looking at, over from 5 days to 130 days, buying when the daily TPI is in the light red zone is a certain winner. Klaus, you ask, how do backtesting results differ by market? US, North. All right. We haven't done just as an extensive backtest as this one. That is mainly due to that we don't have data just as far back. But we have tested a lot of variations of these. We have looked into UK markets, German markets, and the results are basically the same. Because what we're looking at is just a long-term uptrend and a daily retracement. That's all, and we are quantifying it by the TPI. We will come out with more extensive research on the European stocks. I promise you that, Klaus. So just doing this would actually be beating the market. Now, how can I say this? I'll show you a more specified statistics from another strategy just in a second. But let's just say that you, over the last 40 years, have done this, and you have bought the stock that fulfilled the criteria here. You held it for 6 months. Then you would be making roughly 8%, 7.88% here, if you have bought the 2 mid categories here. Now you can ask yourself, is that really that good? 8% every half year? Well, if we're looking into the stats for S&P 500 since 1986, you can see that starting in 1986, ending just I think it was the last Friday here in 2023, and now we're not counting dividends because that is not including in our stats. We will of course collect a lot of dividends if we use the strategy and hold it for 6 months. but we're not counting them in here. So let's have a look at the S&P 500 without dividends. That have yielded 8.67% on average per year since 1986. When we're looking at the stats here, these around 8% is what this makes every 6 months. And Klaus, I will get back to the more specific strategies with max number of positions and so on, because what we have been building as a more detailed strategies, this is just to collect the data to see if just using the TPI actually gives us an edge. And it does. No matter what time frame we are looking at, it actually gives us an edge. We have another one because we didn't just want to test the daily. We have also tested the weekly here, and the results are actually even better here. Here we go. It doesn't say weekly up here, but this is the long-term trend being up and then buying the weekly TPI when it is in an oversold. And as you can see, the difference is not that big here if you're only holding for 5 days, but that kind of gives that kind of natural when we're looking at a weekly chart. So the difference gets more and more clear when we get further up, and we are actually up at a point where holding for, let's say, for instance, 3 months would give us more than 4% on average per trade in positive expected value. This is the average. So this is not just the winners. These are all the winners combined minus all the losers combined. And they're giving an average of over 4% per quarter. That gives, with compound interest, something like 16.5%, 17% in a year. And that actually puts us up in the area of Warren Buffett-like performance. Now, these does not tell us anything about what is the drawdown. I'll get back to that in a second. So they don't tell us about the drawdown, the volatility. Doesn't tell us if the majority of the gains here are made in the first 20 years and then there have been no gains in the next 20 years and so on. This is just to see if there is an edge. Klaus, we haven't tested the 1 year. We probably will at some point, but we had to set the limit at somewhere, but because we just kept filling up our server with data, and we had to compile it and analyze it as well. But the main part here is using the TPI when the long-term trend is up, and either using the daily TPI when that is an oversold accumulation, or the weekly TPI when that is an oversold accumulation. That gives us an edge just in itself. All right. Then, of course, you can build all sorts of strategies. And let me try and show you some results here. The results from the strategies I'm going to use here are only from 2000, but we tested further back, and we do have data, but there were fewer stocks, and our data quality got better and better over the years. So we chose to start our test in 2000. Now, since 2000 and up until today, the S&P 500 has actually only yielded 5.14% per year. Then, of course, there are some dividends sending it up into roughly 7% here. Another thing, and we're not talking too much about that today, but counting the inflation, actually including the dividends and including or inflation and adjusted, actually tells us that the S&P 500 the last 23 years only went up by 4.3%. But 7%, that is what we actually get, and then there'll also always be some sort of inflation. All right. So 7%, that is the number that we should have a look at. Now, the reason for just using let's just find the S&P 500 here. Going a bit down today, but let's have a look at the monthly chart here. The reason why we agreed that this was a decent time span to look at was that you might know your stock market history, but we started around here in 2000, and I do like when I test the different strategies. We do like to have several crashes and sideways market and bull market. Klaus, the reason why I chose the futures here is that I don't think the SPY, that is ETF. I'm actually not sure how far that goes back, but we're going back here with the future to 2000. And if you know your stock market history, there was a dot-com crash here. And that sent us down over a couple of years, quite a lot in the market here. It's the entire internet bubble here. Someone compare that to the AI bubble we might be seeing right now. I'm not sure about that, but some people mentioned that. Then we spent the time from the spring of 2003 and then the next 4 years, 4.5 years, to just get back to the level here that the S&P 500 was at. And then we ran into the financial crisis, 2007 to 2009. Then, of course, the interest rate went basically to zero. The interest rate was a lot higher back here, but the interest rate went to zero. We had all the quantitative easing packages and so on. And then we saw a run up, of course, with a bit of struggle once in a while here. But overall, from March 2009, and up until March 15, we had 6 years of very good market conditions. Then we had about a year of drops and sideways movements, had some run-ups, quite a severe drop of 20% in 2018. You might remember that. We had the couple of very good years up until the coronavirus sent the market down 30-35%. Then we have had, because of all the help packages and all the low interest rates and so on, we have had a fantastic stock market up until the beginning of 22. And as you know, went down, got into 2003, went up, and now it has been a bit jitterish here the last couple of months. November was a very good month, of course. So that is basically the history we have tested our strategies over, meaning that there are bull markets, there are bear markets, there are sideways markets, there are high interest rates, low interest rates, and so on. So it's just to say that when we test strategies, we don't just use a bull market. Everyone can find a strategy that made sense and made a lot of money from 2009 and to somewhere here around 2020. So getting back to the strategies, and these are some very rough strategies. And I should say that what I'm giving you here tonight is basically an insight into that TPI can make money, meaning that if you're buying when it is in an accumulation oversold and the long-term trend is up, you have an edge. Now you can use MyStockScanner and build this TPI indicator into all sorts of your own strategies, using your own stop loss, using everything, and you can test it yourself. We will be testing a lot. But what I'm going to show you now is not a completely, it is a completely rules-based strategy. And some of it I have actually been testing a bit for myself in the Scandinavian market, and it seems to work. I'll get back to the Scandinavian market just in a second. But if we take a look at these two strategies, you're not getting all of the rules here tonight. We will have some webinars later where all the rules are told. We tell all the rules on these strategies on a later webinar, and that is at least most of these webinars will mostly be for paying members. But all of these strategies are based on the TPI indicators and some of our stock scores. Now, the stock scores, if we just have a quick look at them here, just so we all know what that is. The stock scores are the things up here where we are looking at the stock from different metrics on value, quality, momentum, and overall stock score. And then we are comparing it to all the stocks we have from Denmark or all stocks we have from Europe, meaning that, for instance, the Novo Nordisk have a quality, an earnings quality at 100, meaning that it is in the top best percent. It is better than basically 100% or 99.5% of all the stocks in Denmark and in Europe as well. So when I'm in a second talking about stock scores, it is because we are also building strategies on some of these stock scores here. Now, I have a strategy here that have been built, and as I said, it is tested back to 2000 here. It seems like it is working just as well earlier, but we just have better data from around 2000. And what we can see here is that this TPI strategy that is 100% rules based and are only in the largest US stocks from S&P 500 and Nasdaq, meaning that even though we tell this strategy to 10,000 people and they all trade it, it wouldn't affect the strategy much because, well, it's just such a very, very huge market. This is completely rules based, meaning that it comes up with a ton of candidates with specific time frames, and it tells you to buy, for instance, the best 10 or the best 15 or the best 25 out of a lot of different parameters. But what we can see here is that when we tested this, and as I said, it is a very simple strategy. It's nothing insanely complicated. Everyone can do it. But what we can see is that since 2000 and up until now, where S&P 500 has made less than, what was it? Yeah, it has made roughly 5% here. This TPI strategy has turned out 19.9%. Now, this is, of course, CAGR, compound annual growth rate. So this is roughly 20% in average return per year. This is not including trading costs and spread. So if we deduct something like 1% from here, that would be in the high end. So let's just say that this makes roughly 19%. It is not trading that often, so we are not getting killed by trading costs here. I know that this one is saying 6.59. I think that is including the dividend actually here in the back test. The difference between roughly 20 and about 6.5% when you do this over 20 years with compound interest is 8,800% and 385. And Klaus, the specific rules for this strategy is not disclosed tonight here. That will be primarily for paying members. We are building something like, well, we are hoping on ending up with something like 15 to 20 strategies with different time frames, different focuses, different ways of using the TPI indicator, and build them into MyStockScanner, meaning that when people enter there, they can look at the stats for each strategy, they can see how they are derived, and then they can mix and match them as they want. They can pick a number 2, 5, and 17, and they can get an equity line and say, what if I had put a third of my money into each of these 3 strategies? How would the equity line have looked? How would my max drawdown? Because what we should realize is that doing this strategy, we would at the worst point have been down 45%. If some of you were in the Danish webinar on the yesterday where I spoke exactly the same, just in Danish, there was a bit of a larger drawdown. We have worked on a bit of an enhancement of the strategy to make it a bit less volatile. So these are the newest here. And Klaus, you ask, what is the time frame for making this available to the subscribers? Is this just the rules for the strategy? Because if it's just the rules, then it is within the next week and a half. We are doing some webinars about that. If it is the portfolio module where you can mix it all, that takes a bit more time, but that will be sometimes in the beginning of the new year. But when you're looking at a strategy like this, you should realize that 45% max drawdown, that is, of course, in the middle of the financial crisis, and you might have some risk adjustment rules for yourself so that you wouldn't invest too much into a big financial crisis. But you can see here that even here in the financial crisis, back in the dot-com crash, you would have taken some severe losses of the corona crisis here, but you would have been beating the market by a lot. The volatility is quite a lot higher here, and if you are into that and looking at the risk-adjusted return, then we have a Sharpe ratio of 0.78 and a Sortino of 1.16. Yeah, these are fairly good numbers. We can go in and look at this annually. And now this is actually just my own calculations here. You should mind them. What really matters is that we have the years from 2000 to 2023 here, and we have this TPI-based strategy. And as you can see, it does have some losing years. 2002 had 22% in the negative. The market was down roughly the same. The 2 years before, it made 75 and 52%, which was insane. And at the same time, the market was down. The year turned around in 2003. The strategy made 93%. I wouldn't mind have been around doing that at this time. But as you can see, 2008 made actually a decent minus 13% there overall for the year. 2012 was a difficult year, and 2015 was as well. 2018, if you remember that, 20% down in Q4 due to Fed hiking the rates. But otherwise, you can see that actually the returns are fairly good. There are a few years where, for instance, so far in 2023, this strategy has made around 12%, and the market is up something like 20. So this year we are lagging the market. Also in 2020, made around 10%. The market went up 18. So it's not every year that this one is beating the market. There was 2012 down 2%, where the market was up 16. But overall, looking at this, it was making a CAGR of 19.9%, and the market was making just about a third. That was one strategy. There's also another strategy here, not quite as much in return, but still very decent. And what we are trying to find here are strategies that don't correlate too much. Of course, if the market crashes, many of the stocks will crash, and that can be felt all over the portfolio. But otherwise, we are looking for creating portfolios that when one portfolio is going down, the other is going up more than the others going down. So they're not correlating too much. They're not moving in tandem, because then you could just as well have just one strategy and that's it. But what we can see here is the exact same thing. We do have, of course, in the middle of the financial crisis, we do have the big dip here. We also have one back in 2002 and 3, and we have some as well in 19, 20, and right now here. Looking at the annuals here, we can see that last year, if we compare the two, actually, that could be kind of fun. Last year, the TPI strategy made 12%, whereas this one, where we're using the quality scores and some other stock scores, last year, this one was in the negative by almost 25%. But that was following 33, 31, and almost 37%. And then this year, it would have made 31%. So you should have been able to stomach the 25% last year in this rough market. And maybe if you have put half your money in one strategy and half your money in another, it wouldn't have been too bad, because one of them were actually doing fairly well last year. When we're looking back here, we can see it had a bit more of a losing streak back in the .com crash. It was a bit worse hit here in 2008. But otherwise, it has a string of from 2009 to 17, an unbroken string of winning years, a single losing year here in 2018, and then over 30% per year, 3 years in a row. Rough year last year, and then again here. These are some of the strategies that we are building right now, and that we can build and use with quite a lot of confidence, because it is completely rules-based. It is tested far back in time, for in these cases 23 or 24 years back in time, but we have data back further, and also we are planning on testing it on both Scandinavian markets and all over Europe. If, for instance, we are looking in the screeners here, right now we can actually test it, not as, of course, in depth as this one, but we can at least find some of these swing trades. Now, these are not the exact trades from this one, But let's have a look at the strategy that I mentioned here, where we are looking at the long-term green uptrend and then an oversold weekly TPI, because we can just screen for that. Let's just have a quick look at it here. We have the screeners, and if we use the TPI swing indicator here, I have put some rules in. Now right now I'm looking at the US market, but we could just as well look at the Scandinavian markets. But as you can see, we have a long-term uptrend here. That is the lowest of the TPI indicators. That should be in up. The weekly TPI is in either down oversold or up oversold. So these are the two oversold that we know from the charts we looked at. I put some market cap on and said I only want to see stocks that are at a market cap over $20 billion, but that was just to minimize the number a bit. And then I had just removed the daily one. This one, as you can see, I can add it, but I can also remove it. So right now I have removed it. So these are stocks right now that are in a long-term uptrend and have a weekly TPI, some in oversold, either going down or up. As you can see, we get quite a lot of oil and gas here. There's some biotech, some pharmaceuticals, equipment services, biotech, and banking here. So if we're looking at one of these, if we're picking the FANG here, Diamondback Energy, we can look at the TPI, and as you can see, it is in a long-term uptrend, and it is in an oversold accumulation phase here. So this one would be the one to buy right now, for instance. Now, I cannot guarantee that this one will be going up at all. But I can say that statistically, we can see we have an edge. That doesn't mean that the next 10 trades or 20 trades can't be losers. Just as if you go into the casino and you keep playing on red on the roulette table, you might get a string of 20 black. That happens a lot more than people think, actually. So this is an example of how to use it, or we can go for the other one where we're looking at the edit rules. The exact same setup, but just with the oversold on the daily instead. And as you can see, we get some other stocks. We get the Novo Nordisk, the US version, of course. We get Total, we get some financials, technology, and so on. So there is quite a lot of other stocks we're getting here. So as you can see, it is fairly simple to scan for here. And we will get you, all the paying members will get very specific rule sets of the different strategies, what to scan for here, and how to choose between it. But let's say you get here there maybe 100 or 50 or something like that, how to choose the best of them, or at least the ones we in our test can see have given the best results. So just to sum up for tonight here, what I said in the beginning was that if you want to use strategies like this, you need to make sure you have a positive expected value, meaning that if you count a large number of trades, you need to make sure that you on average will be making money on each trade. You won't be making money on each trade, but on average, you should have a profit. After you have made sure about that, we want to put them into a more detailed strategy setup where we make sure that all the profits are not from 1986 to 1989 and then there's no profits after that. We want to make sure that the profits are distributed over basically all the years. Of course, there will be losing years and years where we are underperforming the markets, but overall we want to see a good smooth equity line without too many holes in it. And that is what we are coming up with here. And that is what we are spending a lot of our time on, crunching this data, figuring out how to build the most varied portfolio of portfolios, you could say, so that the paying members in MyStockScanner will be able to go in and pick and choose from a number of different strategies. Here in the beginning, there'll probably be 2, 3, 4 that we publish now, and then we have a bunch of others that we are just crunching the data on in the coming weeks and months here. So that is quite a good Christmas present, I would say. When I first saw the data that we crunched from the TPI, I had a feeling it would be good. but I actually asked Liam to run it again in a couple of variations because the results was a bit too good. I actually didn't believe them when I saw them in the beginning, but we have crunched it in every way known to computer programmers, and it just keeps popping up with the basically the same results. So I'm very confident the TPI will be something that will be included in a lot of my trading onwards, so that when I'm choosing my trades, I'm not using gut feeling or saying, yeah, well, I'm not sure about Tesla, will they win the EV race, or I'm not sure about Novo, will they win the weight loss race. I just use my strategies, my indicators, and basically, I don't even care for, let's say I chose something like NetEase or CDW. Well, I have no idea what they are doing. Well, it says software and IT services, but that can be a million things. But so I could choose any one of these that fulfilled the criteria, and I could buy them, and I would know that statistically that would give me an edge, even though I had no clue of what the company was doing. All right. Let me see, Klaus, you asked, do you have to buy on the first day of the buy signal for the strategy to work? That's a good question. We haven't tested what happens if the stock, if the signal are getting a few days old. We will test that. We will get a lot deeper into that. But what I would personally be looking for was, for instance, we saw an example just a second ago that the price had gone sideways and yet the oversold accumulation still was on. Then I wouldn't mind buying. But we will test more what happens if you actually buy on an old signal, and how old is too old. It could be that for the first 5 days it gives the exact same results. For the next 20 days it wears a bit off, and if you buy it when it's 3 months old, it gets really bad. But looking at the stats here, something tells me that it doesn't matter too much, because if you buy it and hold it for 5 days, 10 days, 25 days, 130 days, you have an edge all along. So that must mean, and I think that is what we will find, that even if you buy it, let's say 10 days after you got the initial signal, then you just have 120 days instead of 130 until this result. So it shouldn't matter too much, but that is what the test will show us. All right. You ask if the weekly TPI values are calculated daily or only when week closes. Now, that is actually a very good question. Let's just go in here, because I think that yeah, you can see we have Monday. Let's see, we have the 4th here. Just make sure I'm not telling you something wrong here, Klaus. Now, this one is turning red, even though it is last Friday. And that is because it's telling us with this that you can imagine it's actually moved 1 day all the time backwards, because this one tells us that from Monday, the weekly TPI on Novo Nordisk will be red. So this one tells us that already when Friday closes here. But it does calculate for a week. It is, as far as I recall, the weekly TPI is holding the same weekly color all week. I think we will find that all of these blocks here are always at least 5 days. And then, of course, if they are longer, it's just because there are more weeks with the same signal. So yes, it must be. It was actually a very good question there. But yes, it is keeping the color for the entire week. All right. Any other questions out there? I won't hold you here for longer than we have to. So we have been around all about positive expected value, the TPI indicator, the screener in MyStockScanner. Are there any other questions out there from those of you participating? And I should say, if you are watching this as a recording and you're watching it some weeks or months from now, you're always welcome to write your questions underneath the YouTube video, for instance, if you're watching it there. And I will get back to you as quickly as possible. All right. Okay, no further questions. I hope you enjoyed tonight. And as I said, under this, when this is uploaded as a video to YouTube tomorrow morning, I will put a link to my stock scanner below it. If you haven't, if you haven't already tested out my stock scanner, and we will also send links with the to all of the participants here. We will send that out to you, and there's a link in there as well. All right. Okay, well, you too, Klaus. Thank you as well, and thank you to all of you for spending an hour here with me on a Monday night here in Denmark anyway. And I'm looking forward to seeing you in my stock scan. I should say there will be a lot of educational material, a lot of investment courses under this umbrella with the My Stock Scanner as well. So you can look forward to a lot of new things here in the coming months in My Stock Scanner. I think it is going to be a really cool product. All right. Thank you, all of you. See you later. Bye.